Picture this. Back in October 1929, you're Robert, a 3-4-year-old bank teller working in Youngstown, Ohio. Your yearly wage is $2,400, which is a tad above the average American income. Margaret, your missus, teaches Sunday school at First Presbyterian and tends a little veggie patch out the back of your place. You've got 2 boys, aged 7 and 5. Back in 1926, you bought your house with just a $12 deposit and a mortgage from the very bank you work at. You've got $3,200 in savings, not a cent in shares, because you've never bought a single one. Back then, spout. What you've got is cash sitting in a savings account at the bank where you work every day. Your job is handing cash over the counter to customers. You can see the vault, and you know it's there. The Dow Jones Industrial Average closed at 381 points that day. On September 3rd, economist Irving Fisher declared that stock prices looked like they'd hit a permanently high plateau. You don't bother with the stock market. Instead, you keep an eye on your savings account, which has $3,200. The money's there right now. Watch what happens next. 4 years later, your bank will be one of about 9,000 banks that go under. Every last cent of your $3,200 savings will vanish, not just devalued or frozen, but completely gone. Back then, there's no deposit insurance and no government guarantee. The Federal Deposit Insurance Corporation doesn't get set up until June 1933, and it won't help you out because your bank closed its doors in March 1932. So that, in a nutshell, is the story of Robert and Margaret. So here's the yarn about what goes down when the place you trusted your dough with, the exact joint you work at, just vanishes. The safe you can see right there, it just stops being there. On the 24th of October 1929, Black Thursday, close to 13 million shares changed hands, double the old record. The ticker tape's so far behind that traders can't work out what stocks are worth right now. In real time, panic selling kicks off before midday. A bunch of bankers, headed by J.P. Morgan's Thomas Lamont, puts together a rescue. Richard Whitney, the vice president of the New York Stock Exchange, struts onto the trading floor full of confidence. He puts in a bid for 25,000 shares of United States Steel at $205, way above what they're going for. The selling stops, the market only drops 6 points by close, and the papers call it a correction. Robert hears about it the next morning, and Margaret asks if they ought to be worried. Robert says, nah, they don't have any stocks. Their savings are all in the bank. October 28, Black Monday. The Dow falls 38 points in one day, nearly 13%, and no rescue crew shows up. October 29, Black Tuesday. 16.4 million shares get traded. The ticker tape keeps on printing until 7-8 p.m., more than 4 hours after the market shut, churning out about 25 pages of trades. $14 billion in value just disappears in a single day. The New York Times talks about chaotic crowds on the exchange floor and faces pale with fear. Robert doesn't own any shares. He reads the headlines from behind the counter at a bank in Youngstown, and his savings account still says $3,200. $1,930, the stock market crash. It doesn't wipe out average Americans straight away. What does them in is what comes next. The banking domino effect of 1,930. Over 13 banks go belly up. The Bank of United States, which goes under on December 11th, is the worst of the lot. It's got over $268 million in deposits from more than 440,000 savers. Most of them are Jewish immigrants in New York, each with less than $400 in their accounts on December 10th. A small biz owner rocks up to his Bronx branch, but the manager knocks back his loan extension. He tells the folks outside, and a crowd starts to gather. By the next morning, over 20,000 people are packed outside just one branch, and cops on horses send them packing. There's no deposit insurance. If your bank goes belly up, you lose your dough. Robert sees the news about the Bank of United States going under and checks the records at his own bank in Youngstown. He gets the numbers, he sees the loans not being paid back, homeowners who've lost their jobs, and businesses that've closed down, but he doesn't say a word to Margaret. In 1931, another 2,300 banks go bust in Youngstown, and the steel mills are cutting back shifts. On August 22nd, local lawyer and diary writer Benjamin Roth notes, "This morning, every bank in Youngstown has a quiet but steady stream of depositors quietly pulling their money out. Roth writes on September 1st that wearing shabby clothes, bragging about being broke, and yapping about how much you lost in the crash have become trendy. Throwing a fancy party or driving a new car is nearly seen as bad form. On September 4th, he writes one line that sums up the whole depression: banks are absolutely shocking. Their demand for repayment on loans and mortgages is the classic story of lending you an umbrella when it's fine and asking for it back when it starts raining. From behind the counter, Robert watches the withdrawals and sees the vault getting emptier. He knows the bank has lent out most of its deposits. That's just how banking works. If enough people all pull out their money at the same time, there won't be enough cash. He thinks about withdrawing his own savings. He decides against it. It'd look like he's not loyal. As a staff member, his job means he's got to have belief in it. Come March 1932, Robert's bank closed its doors for good. He rocks up at 7 a.m. as per usual, and the branch manager's waiting in the lobby. He tells the team the state controllers declared the bank insolvent, so it ain't opening, and depositors will get a letter in the mail. Robert's $3,200 is still locked up in there. He's standing in the lobby, but that cash might as well be on the moon. Over the next few months, receivers flog off the bank's assets, and depositors only get part of their cash back. Bank passbooks are traded for cents in the dollar nationwide, with secondary market prices at 30 cents in the dollar, quoted in daily papers like Livestock. Some depositors get back 40 cents for every dollar, others get sweet nothing. Margaret finds out what's actually happening when Robert gets home at 8:30 inches the morning, instead of his usual 5:30 inches the arvo. He's still got his coat and hat on. By the end of 1932, unemployment was sitting at 23.6%, and average family income had dropped 40% from 1,929. Landlords kicked out 273,000 families in a single year, 9 million savings accounts disappeared, and 2 million Americans ended up homeless. The Dow hit rock bottom on July 8th at 4180, down 89% from its September 1929 peak. It didn't climb back to that level until November 1954. 25 years later, at 1 a.m. on the 6th of March 1933, President Franklin Roosevelt, sworn in 2 days earlier, issued Proclamation 2039. President Franklin Roosevelt ordered every single bank in the U.S. to close for a one-week bank holiday. No American could withdraw a dollar from any bank in the whole country. No checks clear, and no wire transfers go through. The economy runs purely on whatever cash people have in their pockets. Margaret's got $11 in her purse. Robert turns 4 on the 12th of March. Roosevelt gives his very first fireside chat on the radio. He tells the nation that putting your cash in a reopened bank is safer than hiding it under the mattress. He reckons hoarding cash is out of fashion. Banks start reopening on the 13th of March, though not every single one. Out of the roughly 18,000 banks that were open before the holiday, about 12,700 reopen, while nearly 4,000 never start up again. Here's the remarkable bit. When the banks reopen, people line up not to take money out, but to put it in. Americans bring back the cash they'd hidden away. Within a fortnight, they've redeposited more than half of all the cash that was withdrawn during the panic. On the 15th of March, the Dow surges 15%, its biggest single-day gain to that point, proving Roosevelt's fireside chat worked a treat. Roosevelt saved the banking system. But for the 9 million Yanks whose banks had already collapsed, including Robert, there's nothing left to redeposit. This is what saved Robert and Margaret. First, Margaret's garden, the veggie plot out the back, which she'd been tending as a hobby since 1927, became the family's main food source. She expanded it to cover the whole backyard with spuds, tomatoes, green beans, and carrots. She put up everything she couldn't eat straight away, including 37 jars of tomatoes in the summer of 1932. In a letter to her sister, she wrote that the boys gave a hand with the weeding. Rural families across the country followed the same practice. Farming families grew big gardens, got milk and cream from dairy cows, and produced meat and eggs from chooks. They bought 50-pound sacks full of flour and sugar. Even without any cash coming in, the farm wives made clothes from fabric cut out of flour and feed sacks. The farm families managed to get by all right. City families who couldn't produce anything fell into poverty. Second, after getting the sack from his bank job, Robert used his skills to land a bookkeeping gig at a grocery store, earning just half of what he used to. His knack for handling finances, dealing with cash, And keeping records turned out to be useful in other jobs too. As Roth wrote in his diary, the Great Depression was kind to folks with practical skills, whether they were hands-on or mental. Doctors, nurses, and dentists always had steady work. Even though carpenters were out of work, folks still needed them for fixing things up. When money got tight, people who could butcher animals, cure meat, or fix engines could still make a crust. Third, their church community. From November 1931, First Presbyterian ran a soup kitchen, and Margaret volunteered there 3 days a week. Even though it was never said out loud, everyone knew the score. Family of the volunteers got to eat before anyone else. In the years before the Depression, about 1 in 3 adult blokes in America belonged to fraternal organizations. The Masons, the Elks, and the Loyal Order of Moose, these groups provided medical and funeral help, ran hospitals and orphanages, and organized job networks. Back then, these organizations were the only form of Social Security around. Fourth, before the New Deal came along, they owned their own home. Even with a mortgage, Robert and Margaret found it tough, making the steep payments on their reduced income. But because they owned instead of rented, a landlord couldn't just chuck them out whenever. They sorted out a deal with the mortgage lender, a different mob from Robert's old boss, and got a 6-month break on the payments. Heaps of homeowners had their places repossessed, and plenty of renters lost their homes at the same time, but homeowners had an edge that renters didn't. The bank didn't want to take the house any more than the family wanted to lose it. Fifth, they didn't panic. Benjamin Roth's most lasting insight was a perfect fit for Robert and Margaret. What this depression drilled into my head is how crucial it is to have enough accessible cash to deal with surprise emergencies. 3 things are vital: the patience to wait for the right moment, the guts to act when it arrives, and having cash you can get your hands on. Even though Robert and Margaret lost their savings, they still had their home, their garden, their skills, their church community, and each other. Back in 1934, Robert had a solid gig in the accounts department of a factory. Margaret's garden became the talk of the neighborhood, inspiring 4 other families on their street to start their own veg patches. By 1935, life was tough, but doable. The recession didn't end in 1933. It carried on right up until the war kicked off. But the worst of it, banks failing, heaps of people out of work, and food shortages passed like a tidal wave. The ones still standing after the wave receded were the folks who had something the banks couldn't touch. That's the takeaway from Robert and Margaret's story for today. In 1933, the U.S. Congress set up the FDIC to stop Robert's bad luck from happening again, and for 90 years it worked a treat. Ever since the FDIC started, no insured depositor has lost a cent. But the cover is limited to $250,000 per depositor, per bank. Anything over that amount is not covered. In March 2023, Silicon Valley Bank went under, with over $150 billion in deposits, most of it above the FDIC insurance limit. The authorities stepped in and gave an urgent guarantee. So this time round, Robert's bank went under because the blokes who borrowed money stopped paying it back. The bank had those loans sitting on its books. The stuff used as security like property, businesses, and stock had dropped heaps in value compared to what they were originally worth. The gap between what was on paper and what it was really worth just kept getting bigger, till the bank had to close up shop. Have a think about this. Is there a particular kind of loan hanging around on American banks' books right now? That might be worth less than what the records reckon. Commercial property tops that list office vacancy rates in big U.S. cities still haven't bounced back to where they were before the pandemic. A fair whack of these loans is held by regional banks. To try and stop a domino effect, the Fed set up some emergency lending programs, but they're only short-term. Robert didn't lose his dough because his bank was up to no good. He lost his cash because the safety net for people with money in the bank wasn't in place yet. These days, that system's there, but it's got limits, and no one's really given it a proper big test since 1933. Benjamin Roth wrote it from Youngstown way back in 1931. It's still a spot-on description of the difference between the family that makes it and the one that doesn't. The thing about having enough ready cash to deal with emergencies, cash that's not in the bank, but right there with you. Make sure to subscribe so you don't miss the next video.